Welcome, everybody, to Masters of Real Estate. And today we're going to talk all about property management and asset management when it comes to the multifamily space. And I have a really good friend of mine on the line, Tyler Lyons, also a CPA like myself. So we think a lot about the asset management and financial analysis, and super excited to have you on the show, man, to talk to you all about this and really dive deep into the asset management aspect of multifamilies, because a lot of investors don't understand that's one of the most important facets of being a good operator. And how do they know what makes or breaks a good or a bad operator out there, and some of the underlying processes and procedures that you go through on the property management side, on the construction side, on your business plan to be able to get from point A to point B. And it's not always easy and roses. You actually find lots of stuff and holes to fall into and everything. So Tyler, thanks so much for joining us. Can you give a little bit of background on yourself and what got you started in real estate and what your background was, prior to real estate, man?
Absolutely, Matt. Yeah, pleasure to be on the show with you today, brother. We've gotten to know each other pretty well the last few years here, and it's an honor, man. So really excited to have the opportunity to chat with you and your audience here today. Like you alluded to, I'm a CPA by trade as well. Got my degree in accounting in college, went the CPA route right out of college, and worked many years for a Big Four public accounting firm. And once I kind of realized that partner at a Big Four firm wasn't really what I wanted to do, it wasn't long after that I kind of jumped ship and went to work for a pretty large publicly traded company. Started out in the finance department there, and eventually worked my way up to director of corporate finance. And for many years there, I oversaw SEC reporting, technical accounting research, and a general ledger accounting team for $1 billion subsidiary. So needless to say, it's a pretty meaty sort of role. And when I was working my way up the ladder, originally I was thinking that I wanted to become a CFO of a publicly traded company someday. Like, that was my North Star. That's what I was aiming at. And as I kind of climbed the ranks, I had the opportunity to work very closely and get to know very well, became very good friends with the CFO of the company, reported to him, not directly, but on certain things, would have a lot of interaction with him. And kind of saw what the lifestyle looked like in that particular role, kind of saw what it took. And it wasn't necessarily the pressure or the workload that turned me off from that particular idea, but as another one of those realizations, like, man, is that really the path? Is that really what I want for my life?
Do you really want to work 80 hours a week working at a big company like that forever and that be your entire life?
Yeah. Yeah. So I kind of came to realization, like, okay, like, I don't know if this is the path either. And that's kind of a difficult realization, Matt, because at that point in time, it's like, man, I had poured 15 years of blood, sweat, and tears into this career and climbing the ladder. And it started for me a process of soul searching and really trying to dive deep on what I really wanted in life. Like, what was I going to do? So I started reading a ton of books, listening to a ton of podcasts, really exploring what kind of other opportunities are out there. And I always had a little bit of an entrepreneurial itch ever since a fairly young age, and kind of felt like I wanted to do my own thing someday. And through a lot of research and kind of looking at things, I ultimately decided, you know what? If I could buy an investment property and if I could have somebody rent it from me and pay me rent, well, look, they'll pay the mortgage down for me and I'll build equity. And then kind of the next step of that was, well, wow, if you buy these things right, you can actually get really good cash flow and really good yield. If I can get a portfolio of these properties, wow, that could like cover a significant portion of my living expenses. And maybe I could kind of go off and just do whatever I want at that point in time.
Right.
So I started off with a really small a duplex in my backyard up in Michigan at that point in time. And on that first deal and on the deals that I did up there, there were quite a few things that went wrong. I mean, Matt, as well as anybody, a lot of things can go wrong on a real estate deal. But even despite the setbacks on that first deal, the renovation was supposed to be done in 3 to 4 months. It took over a year. I had to threaten legal action against the GC. It was that whole sort of thing, But
you learn a lot of lessons from contractors, so 100%. For sure.
Yeah, no doubt. But I got that deal. I finally got that deal renovated, got it rented out, and refinanced it. And once I got it refinanced and started making money and having my money work for me, what felt like for the first time in my life, and having checks kind of getting cashed and coming into my bank account as I slept, that was a really big turning point in my thinking, Matt, because at that point in time, I realized it might seem a little bit hyperbolic to say this, but I realized that everything that I'd been taught about building wealth to that point in time was a lie, or at least it wasn't something that served me in the best way possible.
Put money in
Because,
your 401k, diversify, check the risk box on the Fidelity form, and
yeah,
hopefully it goes up in value, and really don't pay attention to it, right? So, and put,
absolutely. Yeah, because Wall Street does a very good job of educating people that that's the way to build wealth, and corporations too, because they want you in them golden handcuffs. They
right,
want you tied to that salary and those benefits and those 401k contributions they make for you. There's a lot of comfort and solace in that for sure. What
right.
I realized is that it changed my mindset from the accumulating for a future date sort of way of building wealth to instead let me buy assets that put cash flow in my pocket right now, and then that way I can really try to pursue business opportunities and things that I'm truly passionate about. So that first real estate deal, it completely changed the course of my life and is a really big tipping point moment for me.
It's really important to understand where you started with that, though, too. Going from a duplex in your backyard to now large multifamily buildings as well, and realizing that, hey, those are stepping stones. And a lot of people, they think, hey, I'm not going to get rich off of a single family, and no, you probably won't, but you will slowly gain wealth over a period of time, and you will be able to start learning how to do the right property management or managing the managers, how construction works, all those bells and whistles that you have to learn to do the bigger projects later on. That's part of your, I'll say, tuition that you're doing. Plus, if you're doing it right long term, they will build some wealth for you, even if it's making a couple $100 a month in extra cash flow. Took that $200 and applied it to your cell phone bills or your utility bills, now that's covered forever. So one little piece at a time. This is a grind to get to where, you really want to do larger deals and get bigger spreads and things like that. The bigger the money, the bigger the spread, the easier it is for you to live off of that cash flow as well, from an investor perspective, but also from an operator perspective, where you have some asset management fees to keep the lights on. But if you're not, at scale or doing a lot, it's tough to live off of those asset management fees. And really, those are supposed to be paying your team to do the work for you if you're the business owner, right? So being able to, cover all those things as you grow is, a juggling match, of course. And I think what happens a lot of times is operators go out there in the multifamily space and they get one deal. Maybe they got an acquisition fee or something to help cover expenses or that ramp up period of buying the building and getting it up and running and helping with the costs associated with that. It's not really a major profit center. It really just covers costs. And then when you look at the other aspect of the asset management piece, the next person, the next operator is going out there trying to find more deal flow constantly to get that extra acquisition fee and obviously move forward on the asset management and get more asset management fees also and build that at a super fast pace. But a lot of operators don't actually go out and take the time to say, wait, take a step back. Let's look at the asset management and make sure this building is perfectly performing to our business plan, because that's going to be the catalyst to the future of our growth with our investor base, hitting our preferred returns and hitting our projections and doing everything we can to make this work as much as possible first before going out and finding that next deal and constantly moving, right? So
Totally.
how have you been able to dial in the asset management aspect of this with regarding, the deals you're working on? And maybe we can just pick one of the deals you're focused on and start to work through some of the processes and procedures you see to effectively manage an asset.
Yeah, absolutely. And let's start kind of at the macro here from a asset management perspective, and then we can kind of work our way down to the
Yeah,
micro,
absolutely.
because there are a few things on the front end before you even get to the real nitty gritty, day in and day out, week in and week out part of the asset management. There are some things on the front of that I think are
True.
super duper important. So first of all, when you're even going back to the underwriting and the acquisitions process, whenever we're underwriting a deal and we have a deal that we're really excited about potentially purchasing, before we submit that offer, pretty much every number in our pro forma has been reviewed by a third party, including the third party property management company that we're going to use for that particular opportunity.
Hmm.
So the pro forma rents in our deal, we're doing a comp study to determine what we think the pro forma rents are going to be. But at the same time, we're having a conversation with our property management company to say, hey, look, here's where we think we can take rents. What do you think? On the
Right.
expense side as well. Okay, here's where the trailing 12 results are at. Here's where we think the expenses are going to be. Here's how we think we're going to staff it up. It's kind of a competitive market. Maybe we need a little bit more in marketing spend. We kind of underwrite what we think the expenses are going to be, and we clear that with a third party property manager as well. And really try to get alignment with the third party property management company before we actually get a deal under contract. Because
Right.
the last thing you want to do is really swing out of your shoes on the underwriting side just to get something tied up. And then you
Right.
go to execute the business plan. And it's like, hey, look, you kind of find out or realize like, look, this isn't
Yeah, you're not
realistic.
going to hit those rents, and your business plan is shot immediately after you close and realize that, great, we already own this thing, and all of a sudden you're not hitting the rents, or those expenses were unrealistic, and now the manager's going, I can't believe you expect me to hit this,
Yeah,
So,
totally. And of course, we benchmark the underwriting with the deals that are already in our portfolio as well. For people who are more kind of getting started out, like you're probably going to lean on the property management company's input on those pro forma amounts a little bit more. But we like to do both. We're going to benchmark it against the current portfolio. We're going to have conversations with the property management company, especially if it's a submarket that we don't own assets in. At
mhm.
our firm, we're hyper focused on, and we buy real estate in just the Phoenix market, so we know all the submarkets pretty well. But yeah, it's really good. It's a really good practice to get alignment with your property management company before you actually move forward with the deal. And another thing that I'd say as well that's really important before you even kind of get to the nitty gritty asset management stuff is to make sure that the third party property management company that you're going to use is the right third party property management company for that particular type of deal. You know what I mean?
Mhm.
We vetted pretty much all of the major third party property management companies in the Phoenix Valley. So we've got the benefit of knowing, like, okay, if we're going to buy maybe a little bit older of a value add deal in the East Valley, who's the property management company who's going to be the best for that? Or,
Mhm.
hey, look, we've got this property that's just finishing lease up. It's a newer property, it's closer to downtown. Who's going to be the right property manager for that particular company?
Mhm.
Because what you don't want to do, let's say you buy a class B or C, 70s, 80s vintage, scrappier value add sort of deal, you probably don't want Graystar managing that thing for you, right? You probably want to find more of that scrappier regional sort of property management company to manage that property. And on the flip side, if you are buying that newer class A deal that's just finishing lease up, maybe you do want a Graystar or a Mark Taylor or somebody who kind of focuses a bit more on that luxury sort of product. So yeah, before you even get into the nitty gritty, like there's certain
Yeah,
things
you
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 really
got to
think
basically
about.
back up the business plan first. It starts with the business plan and the due diligence up front on that project before you even start, so you know how to manage that asset and how to move this forward correctly. And I think, a lot of things, a lot of times, you talk about the metrics of the park in itself. What is market rents? What are the expenses associated with this? But it all starts really with the market, because you can't predict those things on the rents long term without understanding the market and what the demographics are and what's happening in the market. Why was it that you decided to pick like Phoenix as a whole, and what are some of the things with regard to the demographics there in that particular market made you excited about the Phoenix market to go into here?
Yeah, great question. And at our firm, ASIM Capital, I mean, we've always been a bit contrarian, and even with some of our most recent moves, I think it's been pretty contrarian. We're kind of in a day and age when it seems like a lot of people are wanting to go from being an operator more to being more of a capital raiser and allocator. We've gone the opposite direction. We kind of went from being more of a broader scoped allocator to being an operator. And the thing about being an allocator versus an operator is if you're raising capital and partnering with people on various different deals and different niches across the country, it gives you a little more license to be more broadly focused, right? I mean, Matt, if you
Mm-hmm.
want to find, a good self-storage deal, like you can probably vet and find a really good operator and invest in self-storage in many different markets across the country. However, if you're going to be the lead sponsor and the principal who really runs the deal,
Mm-hmm.
who finds the deal, who underwrites the deal and puts it under a contract and executes the business plan and really kind of runs the deal. If that's what you're going to do as an operator, it really makes sense to narrow your focus and become best in class and best in the world at one thing. So for us, when we made the strategic shift to say, okay, we're going to focus a bit more, we're going to focus on doing just deals where we're part of the GP and we're really running the show. We realized that we wanted to get more narrowly focused and we wanted to pick one thing that we get really, really good at. And when we did our market research, we looked across many different markets across the nation. And some of the thesis for Phoenix will be pretty consistent with what you see in other very good multifamily markets across the country. We started looking at markets in Arizona, Phoenix, of course, certain markets in Texas like Dallas and Houston. We looked at Florida markets like Tampa. We even looked at some, the Nashvilles and the Carolinas of the world as well. And when you look across these markets, you're going to see a lot of commonalities in terms of population growth, job growth, wage growth, business friendly environments. These are all a recipe that make multifamily investing really strong and give you some tailwinds. Those are all things that these markets have in common. But a couple of things that really stood out to us about Phoenix were really important. And I think they're things that the market just does not give Phoenix enough credit for. First of all, Phoenix is in the desert. So when it comes to weather-related risks, the weather-related risks at Phoenix are really, really low. You don't have hurricanes, you don't have tornadoes, you don't have earthquakes. And because the weather risk is comparatively low relative to some of the other markets that I just mentioned, your insurance costs are much lower. If you're underwriting a multifamily deal in Houston, Texas, I don't know the numbers specifically, but you might be underwriting something like $1,400 per unit of insurance cost. That same property in Phoenix, you're probably underwriting a cost of $400 per unit.
So massive decrease in expense just for that alone, for the weather issues alone. Yeah, we just dealt with a tornado right now in the St. Louis market, and you see this weather, and we'll get compensated from our insurance. It'll be taken care of on a few items, but it wasn't anything major for us. But at the end of the day, yeah, insurance rates when there's weather and water issues in these other states can be majorly significant. Look at Florida, for example, when you're dealing with, it's very hard to get insurance there, period. It's a massive problem out there right now. So, a massive increase in costs. So, I think they could just get rid of property taxes. I'm not sure. I thought they just said they were going to or not. So, in that state, so that'd be pretty interesting as compensation for the difference. Hey,
no doubt.
You're going to be underwater half the year, but you don't have to pay any property taxes, so it's okay.
Which is the way it should be. I'm sure you and I both agree on that, Matt. I mean, if you buy real estate, I mean, why should you have to sit there and continue to pay expenses into perpetuity to some taxing agency? I think you and I probably both agree on that.
You don't own the actual real estate in reality if that's the case. Right. So you're basically paying rent to the government to rent the land, and they just go squander it on whatever the heck they want. So
that's
the fun stuff that you got to deal with. This is why you find every way possible to not pay taxes. It's your duty as an American to pay as little taxes as possible legally, and find the strategies to utilize, which there's a ton of them out there, which is pretty cool to do at the same time. So,
no doubt.
So that that being said, looking at the market aspect of this, and then obviously the business plan from the start, and backing up your numbers there, how do you go about underwriting some of the assumptions to make sure you're being conservative? I'd say on the financial modeling aspect of this, whether that's the vacancy rate or exit cap rates or or expenses. How are you estimating some of those intricacies to make sure that, hey, this is what I believe is going to happen and into the future? And, how are you conservative in those figures?
Yeah, it's a great question, man. I think it's really important to be, people talk about conservative underwriting, and I think it's important. But at the same time, if you just sandbag the heck out of all of your numbers, you're not going to be able to transact. So you
have to have something within reason, right?
Yeah. So there's kind of this fine line between, okay, am I being too conservative? Or the way I like to think about it is I've got defensible underwriting, right? Because conservative's probably not going to get you any deals, but can I be defensible? Like, can I be reasonable?
25% buffer on your renovation is, very reasonable. 50% is, crazy, right? So it's like your deal's not going to pencil if you have to do that, right? So it's the same type of idea there.
Yep, absolutely. So yeah, we're always trying to squirrel away a reasonable amount of cushion. You want a reasonable amount of fudge factor in pretty much all of your major assumptions. You know what I mean? It's like in your rent growth assumptions, what do the research companies tell me is going to happen? I'm going to start from kind of the top line and work my way down. From a rent growth assumption, what do the major research companies tell me rent growth is going to be in this particular market or submarket? And I might taper it down a little bit from what those assumptions are. Like, I'm still going to have rent growth, probably not in year one in Phoenix right now, by the way. We're underwriting 0 to 0.5% in year one. But I usually want a little bit of fudge factor between my underwriting and what the research companies say the rent growth is going to be. When you kind of look at something like staffing, I might try to goose up the hourly rate of the staff to kind of just have a little bit of fudge factor in there. Insurance costs. If my insurance broker tells me it's going to be $400 per unit for insurance, I'm probably going to put about $425 in my underwriting. Even with the debt piece as well, when I look at the interest rate, I'm usually going to have 20 to 25 basis points of cushion between what the debt broker told me the rate is going to be and what I have in my internal underwriting. So you're always trying to build a little bit of
cushion on each provision.
Yeah, exactly. And then, you're usually going to have some business decisions to make as the deal heats up. You might get to a point where it's like, look, we really went for it on a deal we had not that long ago. Ultimately didn't win the best and final, unfortunately, but it was just a really well located asset, well kept. The owner did a great job with it. There was hardly any deferred maintenance. It was a really awesome property. So we kind of made the business decision of like, look, we're gonna take pretty much a lot of that fudge factor out of this deal because we think we can get it. We think there's a lot of upside and it has the opportunity to perform. But yeah, there's always a little bit of a dance of having some fudge factor in there, but sometimes if you have too much, you might underwrite yourself out of the deal. So there's definitely an art and a science to it.
Yeah, and it's hard to predict, right? Because technically, for example, most people you see predicting a normal inflation rate of around 3% on expenses, depending on what the expense is. But, you could be throwing in there a 10% or 20% increase in insurance costs that continue to happen, right? We've had massive inflation occurring. Like technically, if you're being realistic, it could be a 10% expense inflation and you might be flat in revenue growth, right? At the end of the day, over time, you're still going to get that revenue growth just due to the inflationary factors, and as wages continually catch up over time to that inflation and I'll say trickle down, from the government into the working man's hands to a degree, I'll say 1% of it trickles down, the rest doesn't, but it's okay. It does happen over time. But, as those rise, then your rents are much higher than your expenses typically. So you're typically at a much better place, even if your inflation on rents is 5% while your expenses are 10, which would be crazy if that was like that consistently. And, I worry about those types of things on the inflationary side of this, just from property taxes and cities being broke, right? And things like that occurring, right? But there's changes that could occur that could really significantly help the market. Like in Texas, they just got rid of, I'm hearing, the capital gains tax. So, seeing that occur is going to bring more people to the market and some changes in population growth, right? Things happen in different markets that change your business plan along the way. At some point, right, you find the asset, you do all the homework on it, you do the market research, you analyze, the project in depth. You say, here's where my current rents are and here's where my market rents are. Here's the capex I got to do and the plan for implementation of that capex, which is a whole nother problem when it comes to asset management, doing massive amounts of renovation on a per unit basis if you're doing a major rehab. But once you close, what's like the next step? What do you do next if you're, an operator trying to move forward with this stuff? Or have you already started the business plan while you're in closing? What are you doing from the asset management perspective to implement that business plan when you first take over from an initial takeover phase to a long-term asset management phase? What are the primary things you're focused on?
Yeah, absolutely. It's going to be specific on a deal by deal basis, kind of depending on what that business plan is.
Right.
And it really goes back to, kind of making sure that you're aligned with your property management company in terms of what that business plan is. Because when you look at taking over a property, there's usually several different things that you want to do strategically over the life of that particular property to increase the value of that property and improve the competitive position of that property. So when we take over, it depends on the business plan, but usually one of the things that you want to do right away is get the exterior renovations kicked off as soon as possible. Because if you can come in, and if it is a deal that needs that exterior facelift, the first 90 days or so, I want to come in and I want to do that exterior renovation. And I want to show the residents of the community because usually part of the business plan is to push rents a little bit.
Right.
So you kind of want to come in and
give them something.
Yeah. You want to show them right away, like, look, we're not going to just raise rents willy-nilly. Like, we're going to try to make your life better around here. We're going to make it we're going to make the place more beautiful. It's going to be more well kept. So getting in there and doing the external renovations, that's something that right away is something that we like to do, especially if it's a value add business plan and there's a bit of that heavier lift. So
I
that's
like
definitely
that,
something.
along with adding security or fencing or whatever you can do to make it more secure, along with the landscaping, all the exterior work, the pool and the common areas, all those things. Once they're spruced up, now you have a reason to say, hey, by the way, your lease is coming up. We got to raise rents. We're trying to make this park better and everything, or this multifamily better, and it gives you that reasoning to do so, right? So, or
Absolutely.
it gives the manager the reason, so you don't get a bunch of move outs. So.
Yep. Yeah, and usually on these deals too, Matt, we can go as deep as you want in terms of value add strategies and what that looks like. But, usually there might be some sort of exterior renovation element to it, like knock that out right away, like we just talked about. But then there's usually going to be other levers that we're going to look to pull during the course of executing a business plan to really try to improve the valuation of the property. So some of the things that we like to do right now and some of the things that we're in process of doing right now, one is bulk Wi-Fi is just, at least in our market, kind of a complete no-brainer right now. Because what you can do is you can go and find a bulk Wi-Fi provider and you can basically enter into a contract. I'm just going to use round numbers here, but you can enter into a bulk Wi-Fi contract for your community. And you might pay something like $30 per unit to get high speed 1 gig Wi-Fi for the community. And for your residents to go out and get that same quality of Wi-Fi themselves, they might pay something like $100 per month to go do that. So
So
what
you're
we can
significantly
do,
reducing the cost to them of that expense, and now you can raise rents for it, or somewhere in the middle for that.
exactly. So yeah, we might charge $70 per month. We can sell that to the residents of like, hey, look, everybody has Wi-Fi these days anyway, right? So it's like, look, we're helping you. If you can find ways like that to help your residents increase their personal NOI, their personal net operating income,
Right.
it's a huge win and we can profit at the same time. So usually that's another part of it too, is like we're going through alongside the property management company, we're starting to implement and execute on these value add strategies. And one thing that's really important about this too, Matt, is that you never want to do too much at once because we might do bulk Wi-Fi. We usually schedule it out. We'll say, okay, we're going to roll out bulk Wi-Fi in month 3. We're going to go and we're going to implement a full RUBS program in month 6 or month 9. You never want to put too much on people too quickly, or else you're going to
Hmm.
get a revolt. You're just going to have a bunch of people move out. And
Right.
in the heyday of the value add strategy in the lead up to 2020, it's like, well, I mean, nobody really cared because you wanted to churn units and renovate units and get these huge rent bumps anyway. But the last couple years here, we've been in much more of a heads on bed sort of environment where
Hmm.
people are really trying to retain occupancy and just be a lot more careful about executing the business plan.
Right.
Yeah, I think right now in this market cycle, it's really important if you are going to pull a bunch of these levers and add value to schedule it out and to be in sync with your property management company in terms of what that cadence is going to look like.
I think that's really important. Understanding the process and the planning for the business plan in a multifamily. If you're talking about 300 units, right? Before closing and during the due diligence process, you should have all leases with lease end dates and everything ready to go. So you know exactly when the leases are ending, what the current rents are, what they've been paying, their history of that particular tenant, and everything as well. So then you can say, hey, all these ones are vacant. Let's do the exterior work while we market these vacant ones at the higher price. Next phase, let's get this group of people that are now on month-to-month leases, for example, onto full 1-year leases and bump up their rents for this batch, right? Then you do that batch by batch by batch as people renew. And one of the things that we do a lot of times is we try to do a little bit longer leases or shorter leases if depending on the time of year. You don't want a bunch of vacancies in October because nobody moves October, November, December typically. Maybe a little bit more in Phoenix because there's no weather there, but in the Midwest and the South, there's snow everywhere and you ain't moving anywhere in that period of time, and you're going to end up with a 3-month vacancy, right? Especially if you're asking for your rent. You really want your lease renewals to be coming due in February and March and April when people are getting tax refunds and have extra cash, available, as well as the ideal time for lease renewals to come in. You also don't want them all coming due at the same time either. So to have all your move outs at the same time, you really want them to be leases up in, December or January. So then if they move out during that time, you got a month to get it rent ready or something like that, or a few weeks, and then now you got it on the market. So the timing of these things is so important from a retention standpoint, like you're mentioning, that a lot of operators don't understand that piece of it, right? And then same thing like you're saying about the implementation of your value add, right? You could possibly, I could see you getting away with doing the Wi-Fi thing because it's cutting costs at the same time as the RUBS implementation, because then it's a neutral break even and nobody's harmed, even though it's a stressful environment if all of a sudden they're getting charged for utilities and they know they leave the water on nonstop because they could care less, right? When they don't pay the utilities, right? So, but at least, you can implement those things and say, here, phase one is this, or, break even in these cost savings and other aspects. And then now phase two is, these particular units while you're working on renovation units or current down units to get up and running to come in the next phase. And, what I found also is that when you're doing renovations on these units, it's not as easy as like a single family house or something like that, where you're like, you got one project. No, you got maybe 5 units at a time or 10 units at a time or more that you are going through the phase of an eviction or a move out and a rent ready process or a full renovation and upgrade, depending on what you're doing on your business plan. How do you guys handle that part of it where you're, managing the renovation piece, as well? And how do you dial in contractors and make sure they don't screw you? Because we all know the headaches with contractors, of course, so.
Yeah. Yeah, it's a great question, man. And as the asset manager, you need to think of yourself as basically like the quarterback of the team, right? Because you can't let your third party property management company or your GC really just like take control and run things willy nilly. You've got to be very specific with people. Like you need to have your business plan set up on the onset. And for us, Matt, we're not the type of owner and operator that buys a deal every month and just goes cookie cutter, like same exact regimented approach for every single deal. We're more strategic. We're more flexible. And we think you need to be in this
You have to be,
particular
right.
market. But yeah, in terms of, kind of rolling out the renovations, we're always going to be looking first at what units are vacant and available right now. And then you're going to be looking at your rent roll as well. And you want to understand what units might be coming available. That way you can start to get your GC lined up with like, hey, look, we've got 5 units right now. We're going to have 3 units more next week. Get your crew lined up. We've got to knock these out in X amount of days so that we can minimize vacancy. So you have to have a very clear picture in your mind's eye in terms of what units are ready to be renovated, which ones are going to be coming up, coordinating with your contractors and your GC to kind of get in there and do the renovations that need to be done. And in terms of mitigating GC risk, that's always really difficult. I've had money stolen from me by GCs. I know you have as well, Matt. We both have horror stories in that particular area. And for me, one of the best ways that you can mitigate GC risk is do repeat business with people that you trust. And I appreciate for people who are newer in the industry, it's kind of scary because you might not have those go-to GCs yet. But one of the benefits that we get about being hyper-focused on a single market is we already have 2 or 3 really solid GCs that we've done work with already and that we know that we
work,
can count on.
reliable, communicate well, all the good stuff. Yeah,
absolutely. So anytime it gives me chills to have to go out and work with a subcontractor or GC that I've never worked with before. So I try to work with the same 2 to 3 every time, and the deal flow has been at a point where it's worked pretty well. We just haven't had to aggressively expand other contractors that we're working with. So yeah, if you can work with trusted people and just do repeat business, and you guys can grow your businesses together, I think that's a win-win sort of scenario.
That's awesome. Yeah, I think the construction in your team is really what makes or breaks you on the ground there. Your GCs, your realtors, your leasing agents, and you really want to have some empathy. Even though we talk a lot of trash about contractors because we both had pain, in reality, I have a great deal of respect for what they have to go through. I mean,
Me too.
You're getting under a house in the heat of the summer in Memphis, Tennessee, or in Texas, or anywhere in Arizona, where there's like the at least in Arizona, it's a dry heat. These other places, you're just drenched and soaked in sweat, right? But getting under these houses with spiders this big and on the roofs and in attics when it's like 10,000 degrees hotter than what it is outside, once you do that a few times and you walk through some units, you're going, yeah, these guys need some beer. These guys need something. I got to get them to make them happy because they are doing some hard work, and
Yeah.
you realize the importance of a quality contractor that you're working with, and it shows you the importance of your team, because your team and contractors, attorneys, CPAs, everybody you work with will make or break your entire business. And your team, my team has cost me more money having the wrong team members than anything else in any of my businesses. So being able to make sure that you're working with the right general partners on the projects, or the right operators like you guys that, have stuff dialed in and focused on a specific asset class like that. We've focused for years in just the single family market only, until we said, hey, this is up and running. Let's keep this going while we start the lending business as well, because it took that long to get that going. And, I know 1,000 ways to lose money on a house now, right? So after doing 1,000 flips, so you learn your lessons the hard way. So, that being said, can you give us a little bit of an overview of where people can reach you and reach out to you and find and contact you if they want to work with you on any of your deals, or just learn more about, your multifamily business, man?
Absolutely. Yeah, I'm fairly active on LinkedIn, not as active as I should be, but that'd be the best place to connect with me. If you look up Tyler Lyons Real Estate on LinkedIn, I'm pretty easy to find there. So definitely check me out on LinkedIn, and feel free to visit us at www.asimcapital.com as well. And you can join our list there and see all of our investment offerings.
Awesome. And if anybody's interested, we have a 200-point due diligence checklist on multifamily to be able to analyze deals when you're looking at those to invest in, on our website, mathewowens.com. We also have quick analysis sheets. We have master classes on raising capital and analyzing deals, and all that good stuff for you guys for free, just to add as much value as we can to the community and help people. So feel free to go to mathewowens.com and download that stuff. Thanks so much, Tyler. Really appreciate you coming on today, and you're a wealth of knowledge on the multifamily space, man. I really appreciate it, and we'll cheer on the downfall of the government together, bro. So just like in true anarchist form.
Sounds good, Matt. This has been a ton of fun, brother. Truly do appreciate it.
Thanks, man. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list, where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.